Okay, welcome everybody. I do believe we are live. So for anybody who's done live streams before, you probably know the experience, but right when you push upload, it's about 50-50. Some type of error message pops up. I just got one. Today I'm trying to live stream out to 4 different locations. I usually just do 3, but today I added LinkedIn, and right when I pushed that upload button, it said I can either choose to downgrade to 1080p, usually do 4K, but I can either downgrade to 1080 and go live, or I can scrap the whole thing and re-upload everything. So obviously I'm going to send everybody in the wrong direction if I do that one. So I actually downgraded to 1080. Hopefully it looks fine. I think it'll be okay. As long as you can hear me, shout at me if the microphone is broken. But yeah, there's always that little bit of nerves when we start these things off. But okay, so what we're going to do today, it's going to be probably a little bit quicker. I'm just going to do one segment. I do think it's an important one, and I want to have a little bit of time to expand on things. So we're actually going to talk about, for all the short volatility traders out there, of course, most of the community, I'm sure, has experience doing that. It's part of the reason why people follow me. But there's many ways to do it, of course, and not all of them are created equal. So today we are actually going to talk about one method of shorting volatility, that is the VXX, UVXY, the vol ETPs, by stock replacement, using options instead. And there's several advantages that we will go over. So, it's a good skill to have. I think most people should have this one in their toolbox, in their options trading toolbox. So the Q&A will, of course, be right after that segment. You can get your questions in now. But yeah, without further ado, let's get into this. So the one thing that I will say, there was a super chat last week. That means that somebody paid. YouTube, sometimes live streams, that's kind of how people make their money. People pay them, they ask questions. Just remember that my live streams are always free. Don't send any money, but please give the video a like. That would be a very good way to support me. It just pushes it out to the YouTube algorithm and lets people know that a few people watched and enjoyed it. So please give the video a like, and let's get into this. Okay, so like I said, we are going to be basically reviewing sort of a review, not a full extensive review. I have a course that you'll see in a second, but a review of how to short the vol ETPs with options. And you might be asking, well, why would we do that? The standard chart, we flash this thing a lot. But of course, this is the VXX since it launched in January 2009. So it's been going for quite a while. It was the original volatility ETP, split adjusted. Obviously, it's a disaster. And when people see this chart, the first thing they think about, and rightfully so, is how are we going to short this thing? Now, unfortunately, what a lot of people do, maybe they're earlier on in their journey and they just look at that, and the easiest way to get access to that would be literally to short the shares. Now, there's nothing wrong with that. Maybe 60, 70, maybe 80% of the time, that's going to work out just fine. But what happens to a lot of people when they go down that road is they run into efficiency problems, because shorting actually has a lot of logistical problems that can come up. And of course, it is a maximum or an unlimited loss trade. When you're shorting something, not only can you lose all the money in what you put into it, but it can start eating away at the rest of your portfolio as well. That would not be a good thing. So something like the VXX, for example, UVXY is even worse because it's a 1.5 times leveraged product. Let's say you were only shorting 10% of your account, short UVXY shares. Well, the UVXY at certain times can spike up 1,000% or more, 1,500%. So not only do you lose the full 10% that you put into it, but you lose your entire portfolio. Literally blanked, you owe the bank money. So I would encourage people not to do that. And one of the best ways, one of the very simple ways to manage that risk, just a surface layer 1 method, would be to use the inverse volatility ETPs like SVXY and SVIX. So these are essentially the daily inverse of the VXX. Now the SVIX, it tracks an index called the short vol, and at a 1 times leverage, so it is basically the daily inverse of VXX. And then the SVXY, because of the Volpocalypse event, it was deleveraged to 0.5 times. And that one tracks a different underlying index, the SPVIX STR. Basically, they're materially the same. So SVIX, SVXY, 1 times, 0.5 times. The benefit here, of course, is that these are long shares. So worst case scenario, I don't mean to say it would be a fun day, but it could only actually lose 100% of your value. So if you put that same 10% in short vol and you get hit with some type of flash crash or some type of, cyber attack or something, well, you lose your 10%. It would be a rotten day, but it wouldn't be the same as losing 100% and basically exiting and trying to avoid the bank garnishing your wages. So I would recommend that to everybody. There's really no reason why anybody would short the shares outright. We're going to go to the SVIX and the SVXY. So what I want to show is, this is actually fairly specific to one of our strategies, one of our 5 called tactical volatility. And what you will notice when you see the trade dial here is that this is a tactical strategy that during good times, during relatively stable volatility, maybe 60, 65% of the time, we are going to be short vol using the SVXY. 0.5 times leverage product. I'll show the SVIX in a second because people are interested in making those big gains and all that stuff. So I'll show a comparison. But then we will rotate into gold for our safety position and then into VXZ, which is a long volatility ETP. So we will be taking advantage of market crashes and actually trying to make money when the market crashes. But if you look at this, right now we're in SVXY, but down here you can see that there are actually options as well. In every daily email to the subscribers, I actually send out both this very simple long SVXY signal, but anytime we're in SVXY, you can actually replicate this position with options. And that's essentially what we're talking about today. So there is a stock replacement course for anybody in the VTS community. It is essentially just, something I put together and people have access to this. The reason these courses are great too, just on a when I shifted over to these courses, it basically condenses the blog into a very easy to follow place. And it also keeps track of your progress. So when you get through a lesson, it'll tell you that. It'll say what your progress is. Of course, I made the course. I didn't do any of the progress yet, but you get the point. So there's basically 3 that we're going to highlight. The first one, who should use stock replacement? I'll go over all the people that this might benefit. And then, of course, the basic long puts and long calls. That's what you're going to need. Those are the basic building blocks of the stock replacement. I won't go into that. There's rules of engagement, what we're looking for when we do these. But then, of course, we're going to go through the advantages and the disadvantages. So first of all, who should use it? All right, you got to know, is there any reason why you would be paying attention to this? So the first thing is essentially traders who want directional exposure with less capital outlay. So the reason that this is important basically is when you're buying ETFs, when you're buying stocks, of course, there's a margin. If you have a margin account, it's not using up, all your margin, but it costs a certain amount. Now, options, especially long options like we're using, this does not apply to short options, but long options are very capital efficient. So you could actually put less capital towards the exact same market exposure if you do the stock replacement method like we're talking about today. So like I said, even if you're not interested in doing it directly, you could apply this to the S&P 500, the bond market, gold. It is a very good skill to have. So if you just wanted to be capital efficient, this might apply to you. The second one would be Americans who don't have access to SVXY. Now, this would be for people, perhaps, your broker just doesn't allow you to trade it. There are people in certain situations where even if you're an American, even if you have a margin account, you still have restricted access for whatever reason. Could be because it's in a tax-sheltered account that they're just not letting it go. SVXY is a different structure. Could be something to do with that. Some people just are not allowed to trade it. So that could be a reason. The third reason, let's not go there. The third reason would be for non-US residents who need to avoid the 10% withholding tax. Now, don't let this scare you because essentially what's going on is there's something called PTP securities, and the volatility ETPs qualify as that, where they are going to be applying a 10% withholding tax on any securities that you sell. So if you're holding them at all and you buy it and then you subsequently sell it, they're going to take a withholding tax. That's very punishing, of course. Now, fortunately, there is a way for all of the ETFs to get a 90-day exemption, and currently I do keep up to date with it, and currently they are all keeping up with their exemptions. So this isn't really something to worry about right now, but could be applying to you. And if that's the case, either now or down in the road in the future, that could be you. The fourth one, this is kind of a big one. I don't know how many Europeans are following, but we have many in the VTS community, If you are a resident of the European Economic Area, you are subject to what's called the MiFID II regulations. Very, very annoying. I'm sure people have encountered this before. But essentially what it is the US-based ETFs, they have to have what's called KID documents, essentially translations with the regulations and maybe local languages and whatnot, but they have to translate everything, and it's actually quite annoying. What this does is it ends up restricting Europeans from trading US-based ETFs. And, even the big ones, SPY, Qs, but also volatility ETPs would be on that list. So that could be the case, right? You could be facing one of these four things and you think, oh, yeah, that's interesting. Maybe if I learn to simulate with options, that would be where we're at. So that's what this live stream is basically about. So this is our tactical volatility strategy recently, just the signals. And what can we see? Well, we entered on November 1st. Before that, we were just in safety gold, but we've entered on November 1st, and we've basically held it the entire month of November. So you can see what that's looking like. Let's go to SVXY. You can see here, this is, late October. We were just in gold during this period. This is our safety. But once we got the signal to go, it was right there, and we have held it all the way until now. And we're still holding it today. So the first thing that I wanted to do is just basically compare what would be the difference between holding SVXY and doing it through the long put options instead, right? This would be very first barrier. If we can show you that, look, these are basically the same thing, then maybe you'd prefer to do it with options. But if there's some type of massive disadvantage going on here, then you wouldn't want to do that. So let's do that comparison first. We will compare the SVXY profit. This is actually very easy to do. $25,000 accounts for all of them. And we will just say that $25,000 was going to buy the SVXY on November 1st. These are the pricing. I did it as of market close yesterday. It's up a little bit more today, but we're not going to worry about that. And the shares they could have purchased with $25,000. This person, and essentially our strategy, is up 13.8% this month. So the question is, what would happen if you did the stock replacement and you literally followed the exact options that I listed down here? What would a person be at? Would it be anywhere close to 13.8? So this is where I can kind of give you a little teaser on how to do stock replacement as well. Of course, I would always encourage people to get the full course. There's a free trial to VTS. It doesn't cost you anything. If you do it within 2 weeks, you'll get it all done. And then, hey, if we part ways after that, we're still friends. Don't worry about it. But I would, of course, encourage you to take the course. But essentially what stock replacement is, and we can actually go into, this is the Thinkorswim platform, and we can go and look at that trade. So here's the think back function. I don't know what broker you use. Yours might be called something different, Time Machine or whatever it is. But we can always go back and look at past dates, past prices and whatnot. So here's the VXX. We're going to go to the 11th of or the 1st of November, which is the day we entered this trade, and the VXX was trading at 22.46. So there's two aspects to doing stock replacement. And this might not make perfect sense to you right away, but trust me, this is very, very easy to do. Once you do this once or twice, you're going to be good to go. It's just going to make intuitive sense and it's going to be fine. First go around, if you've never traded options before, there is a slight barrier to entry there, I understand, but it's actually very simple. There's really two components here. One is how we get the proper allocation size. And then the second thing is what strike we choose. And I want to show this to you in a fairly easy to understand way. So the first thing is when we're doing the contract or the allocation size, stock replacement is very simple because what we are essentially doing is we're trying to simulate the SVXY with options. So we're going to use the VXX because it's one of the most liquid, volatility ETPs. You could do stock replacement on UVXY as well. It also has a plenty liquid options market. Can't do it on the SVXY, not liquid enough. So that's why we're using the VXX. Remember, VXX is a 1x product. SVXY is a minus 0.5. So we just want to simulate the inverse of half of this, right? Now remember, one option contract is equal to 100 shares of the underlying. So this is actually pretty simple. All you do for allocation size is you look at the price that the VXX is trading at and you multiply that by 100. This is what's called the multiplier. So it's 2246, 2,246. This person has $25,000 to allocate. So all you do is take 25,000, divide by 2,246, and this person's going to do 11 contracts. And then it's just up to the pricing, right? We can go into the think back function, I did the 30 strike. You can see this is the delta column. We'll talk about delta in a minute. I did the 59 delta. I'll tell you why I did the 59 and not the 50. Remember, delta, if you say remember, maybe you don't know, delta is basically the option Greek that represents how much the option contract will change given a $1 change in the underlying. So if we're trying to simulate the VXX at half the time, 50% delta, that's going to be the one you choose. Now, there is a reason, I'll get into it in a little while, why I chose the 59. But you could choose the 50. It's fine. You could choose any one of these. But I did the 30, okay? So essentially, I've done the pricing here. Enter at 985. As of market close yesterday, it's at 13, 11 contracts. This person is actually up 15.4%. So they're actually up slightly more than the SVXY. So you can see that depending on which they followed, one of them is up, 1 or 2% different, but it's basically the same thing. And what I wanted to show is, again, I will talk about delta and theta and all that in just a second, but if you did the exact 50 delta, you can see this one would have been up 13.2%, so slightly lower. Now, hopefully that was very easy for people to understand. Again, when you're doing stock replacement, maybe on the first go round, it was like, I have a few questions. You went pretty fast. But honestly, it's just take the price of the VXX, multiply by 100. That's how you allocate your trade size. And then after that, you just choose the strike, which is a delta. Probably for us, we average anywhere 55, 60 delta, something like that. Now I want to go through the advantages and disadvantages, and you will see what I'm talking about with the theta and stuff like that. So who should use stock replacement? Done. Let's do the advantages and disadvantages. I'm going to rip through this really quickly, of course. If you want to do the full course, I would encourage that. But the first advantage is, and we've talked about some of these, it may allow you to trade otherwise restricted products. So again, tax-sheltered accounts, Europeans subject to the MiFID II regulations, all these types of things, you might be restricted, and stock replacement's perfect for you. Long-only options, basically everybody in every account can do this. It's level 1 approval. It's very simple. Long put options. Pretty much everybody can trade these in any account, tax-sheltered, whatever it is. It doesn't matter. They're more capital efficient. We went over that. Options will allow you to have some money left on the sidelines if you had a good purpose for it. Now, I wouldn't want people to start trading stocks or leveraging up things with that available capital, but I just did highlight one of the things you can do is you can just dump that additional savings into something like a very short-term treasury bond, and you can get an extra 3-4%. I mean, rates are good right now, so that would be a good way to utilize that very efficient option contract, and you'd actually make a higher return just by doing that, dump extra cash into that. The third one, this is important. The maximum loss is capped to the premium paid. So I said before, fall apocalypse happens, cyber attack, whatever it is, flash crash, SVXY, terrible day, loses 100% of the value, right? It would take an enormous level because remember, it's a 0.5 product. So, it would take a crazy spike. But let's say it happened. October 1987, it certainly would have done it. So if Black Monday can come back again, it's going to be a rough day for people who bought the SVXY. But when you're buying options, remember, you can only lose the capital you put up into the trade. Because it's so capital efficient, we are typically only allocating about 20 to 30% of that money to replicate the trade. So even if it goes total disaster, you might only lose 30% of your money, even if Black Monday repeats itself. So remember, you short the UVXY, you lose all your money, and the bank, you owe the bank money for the next 10 years. SVXY, much, much safer, but you can still lose 100%. With the option stock replacement, now you're down to about 30 or 40%, sometimes 20%. It really depends what delta you choose, but don't overlook the fact that capital efficiency and being a long put option, very, very big advantage there. Obviously, this was an ugly day. This is Volatility, February 5th, 2018. If something like that happened, this person's account would kind of flatline around there. They'd still have 60, 70% of their money left, and they can just live to fight another day. So don't overlook stock replacement. It's actually pretty cool. The fourth one is, like I said, delta. Now, I chose the 59 delta. I said you could choose the 50 delta. All it means is, like it says here, delta shows the option value will change given a $1 change in the stock price. So if you want to simulate, for example, SVXY, you just do VXX 0.5 delta. Done, right? You want to simulate short UVXY, which is a 1.5 times product. Well, you could do a 50 delta on the VXX and buy 3 times as many contracts. You could do a 70 delta and buy 2 times as many contracts, and you're almost there. The higher the delta, 75, 80, probably not going to happen efficiently, but you can basically simulate any underlying leverage factor you want. Of course, we've got a pretty decent selection. VXX, UVXY, SVXY, it's 0.51, 1.5. But with delta factor, you can do 0.75. Let's say you weren't quite in that SVIX, right? You kind of wanted to go right between SVIX and SVXY. Well, you could do a 0.75. Let's say you wanted to do really low drawdowns. You could do 0.25 delta. You could 0.3 delta. You can basically custom design it any way you want. You might want to look at the results here for our tactical volatility strategy. And what I'm getting at here, we use the SVXY because I like that risk reward ratio. I try to get my rate of return very close to the drawdown, right? That, to me, that represents exceptional risk management. When you're talking about something like the stock market, maybe it makes 7 to 10% depending on the look back period. But drawdowns can be 50% or more. It can be 5-6 times as much as the rate of return. Bonds, returning single digits, it can have a drawdown 6 or 7 times that much. Real estate, utilities, all trading like that tends to be that way. So for VTS, what I'm trying to do is get that ratio extremely close by being tactical. And if I'm making 30%, I want the drawdown to be roughly, 25 to 35. If I'm making 15%, drawdowns should be, 15 to 20, something like that. I'm trying to get them consistent. But you can see here, it is possible to do the SVIX if people want that extra power. I don't think it's worth it to get the better rate of return, to also introduce a much larger drawdown. I really like the SVXY. Don't let people tell you that just because it's a watered down product that it can't be used effectively. But essentially, delta, you can custom design any leverage you want. And another important one, Vega. Vega is a volatility Greek, and it basically means how much the option will change in value given a 1% change in volatility. So a long put option is long Vega. Okay, so what's going to happen to a long volatility, long Vega position if the market collapses and volatility spikes? If you're in the SVXY or all of the vol products, Greeks don't matter. But when you're options trading, there is that layer. There's, price, volatility, time factor. There's a lot of things that you need to consider. You are long Vega. So if you're in a position, you're in a long put option trying to simulate the SVXY and a flash crash happens. Well, obviously the price is going to go extremely fast against you, right? It's not going to be a fun day. But because you're long Vega, there is going to be a little bit of margin for error where your option value is going to dramatically increase. Now, it's not even going to be close to offsetting the negative delta, the price move that it's going to go wildly against you. But that increased Vega can actually benefit you. And I did a YouTube video. I think I linked it in the course. Let me see, just to make sure. I did link it in the course. I basically compared 2 periods where one of them was in the ETF and one of them was in stock replacement, and I compared different market crashes. And it's really clear you can save 5 or 10% just based on that Vega factor. It's not going to offset, going to be a rough day, obviously, but that is a major benefit to stock replacement. Now, too bad there's not all advantages and no disadvantages. So let's talk about a few disadvantages. There's not that many, but they are worth mentioning. First of all, small educational barrier to trading. Now, hopefully I did a reasonably good job telling you that I don't even care if you've never traded options before. You can learn this in a couple of hours and a couple of live trades. It'll just become, it's not difficult. Buying long put options, you can definitely handle it. But it's worth saying that there is a slight educational barrier there. Again, take the course. I hope it's laid out in a way that makes sense. I'm sure you'll be fine. The second negative aspect, and this is worth talking about, is the theta factor. So theta is that third Greek that we focus on. Theta represents time, and when you are long put options, you are theta negative. You are essentially bleeding a little bit of capital over time. Theta shows how the option value will change given the passage of one day. Now, the thing to note is we can actually fix this problem for ourselves mostly by understanding how theta works, right? It decays very slowly and long term, and then it speeds up substantially as you get closer to expiration. So how we solve this, we do one of two things, or we do both of these things. One, we trade long-dated contracts. So when I went to the ThinkBack platform and I said on November 1st, I sent out trade instructions for this 30 put option on the VXX. Notice this is 135 days to expiration. That's why I keep it so far out. Because if you're talking about the theta factor, we want to make sure that we're playing over here and not over here. We're not doing short-term options. And then the second thing you might be thinking, well, what happens if you hold the position for 2 or 3 months straight? Well, we rebalance within 75 days. So all I will do is if this contract gets within 75 days, I will just roll it out to the very next month. I'll just send out the trade signals. You'll open up your email. Down here, it'll say, we are just doing a simple rebalance. We're closing this one and we're opening the new one. It couldn't be simpler. But it is actually important to keep rolling that theta forward because it will start to accelerate over time. And you remember I showed you the difference in pricing. The 59 delta was up 15.4. The dead center 50 delta should be exactly 13.8, right? I mean, if everything is all efficient, it should have been 13.8. It was actually 13.2. There is a little bit of theta bleed there. So what I would say is just back of the napkin, rough estimation. If you're looking at your delta factor, the reason I chose 59 and not the 50 is essentially for that accounting of a small theta bleed. You could do the 55, whatever it is, 10%-ish. So if you're doing a 50 strike, or a 50 delta, you push it to 55. If you're simulating UVXY and you're doing, say, 3 contracts, you could do 3 of the 55 delta and you're good to go. Then you've shorted the UVXY in an extremely safe way, right? So that's a disadvantage. The third disadvantage is Vega factor. I mentioned it as an advantage, but it could be a disadvantage if you're trying to go long volatility, right? Because imagine, again, when you're short volatility, you're buying a long put option during relatively stable volatility periods. So Vega's not going to hurt you. It's going to help you. If you get a massive market crash, that Vega's going to be a margin for error. But when the market is crashing, volatility is spiking, now we're going to be moving into long volatility. Well, now you're buying Vega. Now you're buying expensive Vega options, right? And essentially, I mean, obviously there's a million things to talk about options trading, but if you want to reduce it to the lowest common denominator, you are essentially selling things that are expensive and buying things that are cheap. So when you're buying and you're simulating long volatility with long put options, your Vega factor's on the wrong direction there. So if, for example, the government, some scare, everybody's terrified, stocks are crashing, government comes out and says a piece of good news, sometimes you get those really strong V-bottoms in the market. You can get hit twice with that. First of all, your position will go against you price-wise. And secondly, that volatility is going to crush on you pretty fast. So what I would say is, you don't want to be buying long put options that are Vega positive trades. So there are other things you can do, and you can dive into my work a little more. There's risk reversals that involve a short and a long. There's vertical spreads that involve a short and a long. There are ways that you can do that, but you don't want to buy the most extreme long Vega positions, which are just long single options. So we don't actually do that. And if you do that, it's fine. If you catch it right, you're going to make your money, but just be aware of it anyway. Kind of an easy fix, but there it is. And the fourth thing is liquidity. Now, it doesn't matter VXX, UVXY, but like I said, this is a skill that I want everybody to learn for all of their trading, right? So simulating the S&P, simulating gold, treasuries, you start to get the universe shrinking on you a little bit because you do need a highly liquid options market. So you can't trade anything with barely any liquidity. We've got a universe of thousands of ETFs to choose from, but really you're going to be restricted to 5 or 6, to be honest. So just be aware of that, there you go. So that is essentially the disadvantages. And just to wrap this up, what I would say, because people are probably looking for the conclusion, and you're probably hoping that you can actually see what I'm looking at, is I would say they're still about the same. Right? I really like stock replacement, as everybody knows. I talk about it a lot, but there's nothing simpler than just buying the SVXY, right? So I don't know. I don't ask personal details about any of our VTS members, but I would imagine it's somewhat of an even split. I would imagine that a lot of people use the SVXY, probably a few people out there I don't know many. I've tried to discourage people. Let's close some of these windows. I've tried to discourage people from, chasing shiny objects. Hopefully not that many people are using SVIX, but I would imagine there's a few of you out there. You know who you are. But essentially, I consider these about a wash. So stock replacement's fantastic. It's just that slight barrier to entry for the education factor, but don't worry about that. It's all good. So instructions are there for everybody in every daily email. There's a live trading example here. This is essentially, I think it's like a 10-minute video or something. I went through the whole thing, and if my little rundown here was too quick for you, again, there's two routes. You can start to watching the videos, or you can just jump in and actually do the course. So there you go. That's stock replacement in a nutshell. On the VXX, a UVXY, you can do basically any leverage factor you want. You can create your own volatility exposure with a very simple option structure. You just have to get the allocation size, choose the delta strike factor. Pretty simple, right? Okay, so what we want to do now is get into the Q&A. Now, last week, if you tuned in, I had a problem with the echoing. So I'm going to do a test here. And I want everybody to start screaming at me in the comment section if this fails like it did last week. If there's a ridiculous echo going on, make sure you let me know. So what I've figured out is what I can do. Bear with me here. I'm doing this on the fly live. I can actually click this echo cancellation. And then we're going to just hear a word from our sponsor of this video, and then we will get into the live Q&A. So you can actually start putting your questions into the Q&A now. Hey everybody, so please just allow me 1 minute of your time to introduce my work, and then we'll get right into the live Q&A. So I launched VTS in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Now, our portfolio is currently 5 strategies with low correlation to the stock market and to each other, so it's a completely diversified total portfolio solution. It's also not active day trading, and trust me, anybody from any background can follow in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for 18 years now, and I share a lot of invaluable volatility data from our dashboard in every daily email to subscribers, so you can learn the same tools responsible for my success. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS available to everybody down in the description below or on my website. Come join members from almost 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Nobody screamed at me, so did my little 1 minute ad reel. Everybody could hear it okay. There was no echoing. All right. Because last time I played a video, I prepared this whole 5-minute video, really wanted to show it, and almost immediately everybody in the chat is like, echo, echo. So, yeah, that was a big fail. But I think I figured it out. It's just on the fly. I have to click this echo cancellation. Now, if I have it on the entire live stream, which I almost made that mistake, fortunately, I did a pretty extensive test beforehand, but then this microphone starts cutting out during the rest of the live stream. So I actually do have to do it on the fly, which is unfortunate. There's going to be times in the future I forget, and all of you regulars are just going to scream at me, and I will understand immediately what to do. So let's do the Q&A. Now, of course, you can ask me anything. You can also do off-topic stuff. People don't often ask me off-topic stuff, but one of the things that was fun, I was in Panama for a couple of months. A couple of years ago, I used to be a resident of Panama before I was a resident of Dubai. And I did an off-topic. The rule was no investing, no trading, no business, nothing. You just had to ask embarrassing off-topic questions, and had a glass of wine, and people asked me stuff. It was a lot of fun. So you can ask me about these other things. I am a workaholic. I'm pretty much, working, investing, trading most of the time, but I do a few other things. So feel free to look over that list if you are like me and you're interested in a few of those things. Go ahead. Or you can just try to ask me embarrassing things and get me canceled. It's all good. I manage my own business. Nobody can cancel me. So there you go. Or you can try. Maybe I'll say something epically stupid and people just stop watching. All right, nope. Oh, yeah, that's the top one. The other one's mine. General thoughts about VVIX, volatility of the volatility, volatility of the VIX. What can we extract from the statistic? So the VVIX isn't overly useful, unfortunately. It's one of those things that I see a lot of people talk about it on Twitter. They try to make it sound a little bit better than it actually is. I always categorize volatility metrics into two basic piles, right? The first one are the ones that I'm more interested in, and these would be ones that metric is instructive on the broad market, right? We can get some actual directional trade signals based on this volatility metric. So, for example, the VX30 to VIX roll yield, the traders VRP, the cash VIX oscillator. These are all things that VTS members will know what they are. Those things are very instructive for our trading. Then there's this other pile over here that would be metrics that are basically more specific to a use case. And I would put the VVIX over there. VVIX is the volatility of the VIX options. So it's really not going to be overly instructive. Of course, the VIX options, the VIX market, the whole complex is already a derivative of something else. So you're getting pretty far removed when you get to the VVIX. But if you're taking specific option trades on VIX options, then yes, it might be instructive to know whether it's high or low. Again, like I said, it's, there's a lot of gray area, but essentially option trading comes down to sell things that are expensive, buy things that are, not sell things that are expensive, but to overpriced and buy things that are underpriced. VVIX can give you a signal to that. There's one other thing that I might mention. This is hit and miss, so don't count on it all the time. But let's say that there's a big market crash. Obviously, volatility spikes. What you're looking for if you're trying to time those reversals, and it's very difficult. I don't front run the market. I wait for confirmation of signals. But if you are one of those people that just feels that need to try to get that reversal, what you can start looking at is if the market is making lower lows and the VIX stops making higher highs. That would be one sort of entry signal. And then you could take it a step further. And if the VVIX is also rolling over and going back the other way, oftentimes that could be a signal that the market is kind of exhausted and may be ready to start reversing. Now, obviously, keep your risk management in place. Don't just slide your chips and go all in and say, oh, he told me, lower lows in the VIX. That's the sign. No, I didn't say that. Keep your hedges on. Whatever you do, keep safe, because obviously just one more piece of bad news, it could keep going the other way. But if you're looking for a somewhat signal of a reversal, the VVIX can be that. But more or less, it is just the volatility of VIX options. So very specific to one small area. Okay. When a 10% portfolio stop loss gets hit in a covered call strategy, when do you restart the strategy again? I assume you mean my Wheel of Fun strategy. You said you do not own any. I'll do that after. Yeah, I would assume that you mean the Wheel of Fun. So immediately. The answer is immediately. So I've gone over this a few times, several live streams, but I'm not really going to talk about what the Wheel of Fun is. I've explained it pretty thoroughly. It's pretty basic. You're just collecting premium on both a cash secured put that gets assigned, you sell a covered call, you get out of it, and you keep going around this wheel. It's called the Wheel of Fun. So essentially, I keep track of all my live trades, of course, and all that I do is I keep track of where I'm currently at. And I don't think this is updated immediately for right now, but it was several hours ago. So I'm currently in a drawdown. All I do is I institute a 10% total value stop loss. I want to make sure that I'm not going too far down. Essentially, sometimes you can get really caught. So as an example, in March, I sold a $50 cash secured put, and I actually got assigned the shares at 50, and it bled all the way down to 25 by the time I actually got my shares called away. Just selling covered calls all the way down, and eventually I hit my stop loss. Not quite, but I had to pull the plug and I got my shares called away. So essentially what would happen in this case is that's $25 of bleed, right? 50 to 25, but I'm collecting a lot of premium along the way. So I actually collected 17. Let me delete that. And I got out. But you can get right back into the same trade immediately. So the reason that I do the stop loss is for that discipline. I don't want something that I got assigned at 50 and it goes down to $4. You know, your covered calls are never going to pay once the VXX starts to go down that extreme. You're always going to be farther behind. You're always playing catch up, trying to get those little pennies and reduce your cost basis. And eventually what you're hoping for is that you get a week of, bereavement and the VIX spikes up and you get out of your trade. But sometimes that doesn't happen. Sometimes the VXX just does its thing, right? I mean, we've seen this. It is not surprising to, eventually you're going to get caught in one of these downdrafts that there's no way your covered call premiums are ever going to make up for it, and you're just going to stop out. So if you set it at 20%, you're going to eventually get to 20. I set it at 10 so that when I can bail out, I can immediately start selling really strong puts again. Because what would that mean, right? If you are stopped out 10% because the VXX went too low, there is diminishing returns there. It's not going to go down forever. So the lower it goes, obviously anything can happen. It can still go lower, but it should start to level off. And that means that progressively over time, it's actually a stronger position to be getting into those positions. So I would just pull the plug, scrap whatever it is, which usually means selling the shares that I got assigned and also selling the covered call that's protecting it. Just call it at 10, and then the very next cycle, get into an out-of-the-money short put option and start all over again. But you can start right away, right? You don't want to miss that window because it is a good entry point. So the stop loss is just there to protect you from, that emotional battle that we all play. And a lot of people just don't like to take their losses. They just can't take their lumps and move on. So I institute a 10%. It's not a high return strategy targeting, let's say 15% a year. I'm not going to let this thing draw down for 20, 30%. If it's down 10, I'm out. Much more comfortable on the put side. So that's what I would say. You can start immediately, the very next weekly cycle. Okay, you said you don't own any books. Do not like reading books. So on Twitter, this backdrop, this absolute mess of a wall behind me, I just wanted to change my studio. So I got a full wall thing there, shelf. And then it occurred to me, I'm a minimalist. I actually don't have any stuff. So what am I going to put on it? Somebody said books. And I think on Twitter, I said books. I don't read books. I don't own any books. You can actually see some books there. How do I move out of the way here? Those are not my books. Those are my wife's. She's a sommelier, wine sommelier. Those are her wine books, right? She's done level 1, 2, and 3. I don't know if she'll ever do level 4. It's all in English, and that'll probably scare her off a little bit. But those are her wine books. I have no books. Why don't I read? Well, essentially, I actually like the concept of reading. I would like to be able to read. It's not that I'm against reading. It's just pragmatically, there's always this romantic idea that, you sit in a comfortable chair with an actual hard copy book and you read a book. That would be incredible. But I'm a workaholic and I already work 10 hours a day. I do like to get a workout every day. I do like to hang out with my wife. And there just isn't enough time in the day. So I listen to audiobooks. I listen to, when I'm in the gym, there's always an audiobook playing. I go out on long runs. I'm a runner. As you can see, there's, 10 pairs of running shoes behind me. I run very long distances. When I go out running, I typically do between 16 and maybe 24 kilometers, right, in individual runs. So I'm out there for an hour and a half. Yeah, audiobooks. But I just don't have the time to sit down and read a book, unfortunately. So I didn't mean to say I'm just anti-education. Sitting down and reading physical books, that would be a dream to have that much time on my hands. But I can't. I can't read. I know how to read. I don't have the time to read. Do you have a favorite of the volatility metrics you track? Well, that's kind of a cop-out because, of course, my number one favorite is the number one metric in the whole world, in my opinion, would be the volatility barometer. But that's cheating because it is a comprehensive metric of all the volatility metrics, plus, several more that I like to track myself. But if you're limiting me to the other ones, it's down to 3. So cash VIX oscillator, VX30 to VIX roll yield, and traders VRP. Probably I'm going to throw VIX to VIX 3M ratio in there as well. So there's 4. And I can't tell you which one is the best because, as you probably know if you're asking this question, we have 5 strategies. And it's not diversification if all the strategies are getting signals from the same place, right? Then they're all going to be basically correlated and moving the same direction. So each of the strategies focuses on different metrics. And I can't say which one I like the very best. The reason that we have a starting 5 lineup is because these are my 5 best strategies. I have 15 more. They're always running in the background. I'm always testing and perfecting and trying to do the best I can. But it takes an awful lot for me to replace one of these 5. And so these are tracking different metrics, right? The strategic tail risk, for example, is very heavy. It's direct for the volatility barometer. This number is the signal for this strategy. That's what that is. But these other ones are not. The tactical volatility has more of a focus on everything VIX futures related, everything VX30 to VIX roll yield related, whereas this one is a little more geared to the cash VIX ratios, the VIX 3Ms, the cash VIX term structure. All of the strategies are a little bit different. That's what diversification means. So if you're going to hold me to those, I would say those four. Say the Traders VRP, the cash VIX oscillator. I might default to that one just as I'm saying it in my head. The VX30 to VIX roll yield. And then what was the fourth one that I said? Whatever the fourth one I said was. What did I say? Yeah. VX30 to VIX roll. I don't know. I said those four. Rewind the tape. It's late. What is it? 2:46 a.m. for me. I'm in Taiwan right now. I will be leaving quite soon. I'll be back in Dubai in maybe a couple of weeks. So if any of you are hanging out in Dubai, live in Dubai, we can meet up at Starbucks and have a coffee. Do you have a favorite? Okay, good morning, good. Any upgrade timeline? No upgrade on the timeline. Doing the best I can. I think, yeah, I'm really trying. That's all I can really say. It's kind of a point of stress for me because I've got an overwhelming amount of work to do. And that is one thing that I would love to bring back. For many years, we had VTS and then VTS options, and it was great. But I just got overwhelmed with work, and I had to choose one of them, and so I closed down the VTS options. As I've said before, it was great. It was running fine. There was about 600 people following it, so it wasn't for any specific reason. It was just I was overwhelmed, and I don't ever want to put anything out or stand behind anything that isn't the best that it can be. And my time was a little restricted, so I thought, you know what, I'll just take the hit, right? I never talk about money. I never talk about finances, but I don't know how many people could actually do that. Just say, hey, there's, $250,000 a year income stream. I'm just going to scuttle that for a couple of years because I can't have the time to put out the very best product. I could have just kept going and just keep collecting that, $250 a year, but no, I didn't do that. I shut it down. And when I'm ready, when it's good, when I stand behind it 100%, then I'll reopen it, but not until then. I don't do this for money. I do this for, as I've always said, just making me proud to build the body of work and to serve people. So I'm not going to put out things that aren't 100% my best work. Okay, this is interesting. In the volatility trend strategy, what criteria determines using the VXX as opposed to using the UVXY? Really no criteria at all. We can use both of those equally. What are we in right now? If memory serves, we're in the VXX, correct? That would be embarrassing if I was wrong. Yes, we are in the VXX. But the volatility trend strategy, which is right here, we're in the VXX right now. We have room for another trade. But essentially, the VXX and the UVXY are both very liquid options markets. So we can just do both of those at any time. It really just depends. And it's good that we have both of them because pricing matters in the option world. When you get something like the UVXY, it's much quicker to get down to those single digits. So if you imagine you're trading a butterfly on the UVXY, once you start getting down to these low numbers, it starts to become less efficient, right? And then if it gets really low, it becomes untradeable. I wouldn't say we're untradeable right now, but it's getting close. Single digits, you're looking at butterflies, 9,858. You can see the premiums are really nothing there. There's really difficult to trade. So that's why we can actually still default over to the VXX and we can get that. One of the issues that we faced, and you'll probably remember last year, we actually just took a couple months off. We didn't take any trades because the UVXY bled down to the twos and the VXX was taking its time doing its reverse split. So, we had to wait. But then once the VXX got back up to 50, we can use it at will basically. And then the UVXY did its reverse split. But it's already, you can see, it's bleeding down pretty low. So there you go. Choose based on efficiency. Are you fully risk on today? Yes, fully risk on. Have been for the entire month of November. As I showed, basically for that strategy, I can show you hopefully I don't flash some of the secret recipes here. But yeah, you can see we entered November 1st, defensive rotation, November 1st. We've basically been strong net long the market in November, right? Not only are we basically long all of our strategies, but we're 2 times the NASDAQ in this one. So November was a good month. There's no doubt about that. But I look at long-term only, everything long-term. You know, I never brag about good months and I never make excuses about bad months. You'll note, I mean, we had a killer month, not one single tweet about, you know, performance at all. I don't care. Long-term performance, long-term track record, because, you know, what you see on Twitter, of course, they're all just a bunch of frauds, basically. They're high-fiving every single thing that goes well, and they're completely ignoring everything that doesn't go well. And it gives people the illusion that, oh, wow, look at all these incredible traders. No, they're not, right? If you saw both sides of the equation, you would very quickly realize, oh, I see what's going on here. So I've just always adopted the policy that I'm not going to pump and, you know, self-aggrandize my work, and I'm not going to do that. And on the flip side, I'm not going to come out and say, oh, well, you know, we took a big loss, but it wasn't my fault, or it was the Fed's fault, or, you know, the market's manipulated. I don't do any of that. No excuses and no bragging. Just smooth. I can maybe squeeze in my token single golf analogy here, but when I was golfing, pro golf back in the day, one of the most important things is trying to maintain that flat line, because it might not sound like it, but playing a 4-round golf tournament is extremely stressful. And one of the hardest things about golf is that it's so slow. Sometimes people think, oh, well, you know, a hockey game, obviously that's way more difficult than, you know, a golf game. One of the things that makes golf so hard is that a tournament comprises 4 days, basically 20 hours, and you really want to focus on keeping as stable as possible. So back when I was playing, it was important for me to, if you look at me, if you talk to me on the day, you should not be able to tell whether I'm 10 under par or 10 over par. You should not know the difference. My mannerisms should be the same. The speed I'm walking will be the same. My heart rate will be the same. I used to wear heart rate monitors and track everything. You know, when I'm putting out on the, you know, the last hole of a tournament, my heart rate, you know, it elevates a little bit, of course, but training, I can actually get my heart rate within about 10 beats per minute of the final day on Sunday with hundreds of people watching as the, you know, the first tee shot on Thursday when nobody even knows you're teeing off. So again, trading is kind of the same thing. I don't think it's beneficial for those people. Now, I know they're doing it for business purposes, but I take this seriously. I'm a professional trader, right? I was a professional golfer, and now I'm a professional trader. It is very important to manage those emotions. So for me to be, you know, all over Twitter, it's just not my style. I know better. Maybe those Twitter gurus don't know any better, but I know better. And I can take a really good guess what their actual track record looks like. It's probably significantly worse than it appears based on their tweets. Okay. I've heard you say that you do not generally read or listen to news, read books, study other people's work, etc. Is it mainly to save time, or because you do things of value and you think being productive with your work is better? Yes. Essentially, I think I answered that. You asked that probably after or before I answered the other one. But yeah, it's mostly time constraint. But you mentioned the news thing as well. This is also interesting. Because I'm so immersed in my work, sometimes I will go on Twitter and I'll see something trending. I had no idea it was happening, right? Because I'm not immersed in the news, and I don't really do that. I'm kind of in my work, in my zone. I focus on the things that I can control, and I kind of try to ignore everything else, right? Stay in your bubble. Everything I can control is in here, and everything I can't control gets thrown out of it, right? And so news, following those feeds, the latest, like, you know, whatever it is, the wokeism or the, you know, all that stuff, I'm somewhat oblivious to all of it. And then I will learn it by jumping on Twitter. So it's basically just a time constraint. We've all got 24 hours in the day, and I've chosen to spend my 16 waking hours mostly working out, and any spare time I have with my wife. Pretty boring. and hopefully some golf this year. I golfed, I think, 25 times last year, which was a massive record for me. I'm typically in the 1 or 2 times per year range. Last year, I joined Emirates Golf Club in Dubai, got access to 3 different golf courses, basically 5 18-hole courses. I played in the 20s. So hopefully this year I can do the same. Okay, I've had some luck in the past doing 14 to 45-day expiry single put option contracts on VXX, about 2 to 3 strikes out of the money. That's specific days to expiration. 14, I guess 2 weeks just mentally. Usually in these cases, I can scalp an average of 20 to 35% returns in 1 to 3 days. Thoughts? The reason I bring this up is my account is under 25,000 for the pattern day trading rule. This is what I'm comfortable with, but any opinions and advice? So, look, this is the least fun part of my job, when I have to basically throw cold water on people's enthusiasm. So obviously there's a lot of information missing here, but the first problem with what you're talking about, and I touched on it with the theta decay, is if you're buying single put options on VXX 2 weeks to 6 weeks out, you're in that theta decay range. So of course, if you get trades that kind of just flatline, they just tread water for a little while, you will be bleeding capital. Now, I understand that last little bit, you can scalp an average of 20 to 35% returns. 15% a year long-term is absolute world-class, top 1% investors across the world. So to be talking about 20 to 35 in 1 to 3 day periods, I think that's a little bit of recency bias. And I'm not trying to be rude here. I mean, thank you very much for the follow, for the interest in my work. But I mean, is it possible that you're basically factoring this a little bit too strongly? That yes, granted, in the last year or so, there have been some pockets of just easy, tremendous success. I guess what I'm saying is, I mean, 20, like, no, just no. That level of return long-term is just not going to sustain itself. So what I would suggest you do, without throwing all the water and just burning out all this fire here, I would say that you want to tone it back. One of the best times to really scrutinize your performance is when it's going very well. Because a lot of times people scrutinize their performance after they take a devastating loss, right? It's natural. You have blind spots, we all do. You take a massive hit, and that's when you say, okay, wow, I didn't see that one coming. Let's figure out what went wrong. Actually, one of the best times to scrutinize your performance is when everything's going perfectly well. Because what you're describing, I am not saying it didn't happen. I can see what the VXX has done in the last 6 months to a year. I can tell you that you are probably correct in those numbers. You're probably crushing it. The more risk you've been taking, the better your returns have been. But what the smart trader would do is they would put that into the grand scheme and say, well, clearly those types of returns would make me a trillionaire, and nobody has ever achieved that before. So you're not going to be the first one to make 35% every 3 days. That's not going to happen. So now what you need to do is spend some of those profits to start adding layers of risk management before the devastating loss happens. That's why I say now is the right time to look at it and say, okay, that's awesome. I got a lot of cash in my pocket. Maybe it pushed you up very close to that 25K and you can cross over the pattern day trading. That would be fantastic. But the last thing in the world you want to do is wait for what is inevitably going to happen. You can't make that rate of return without taking on insane risk. And what's going to happen is it's going to bite you really hard. So don't want that to happen to you. I want you to take your profits. I'm not saying close out your trades. I'm just saying that now would be a very good time to try to really play devil's advocate on what's going on. Like, what could go wrong? Ask yourself a series of questions. Hey, if the VXX did this, I know a lot of us in our head, we say, oh, that'll never happen. What if it does, right? Do a stress test of your strategy right now. What would happen? And I would imagine, if you're honest, a little bit of this will be, well, it has been a pretty advantageous period the last 6 months. Perhaps my strategy isn't actually making double digits every few days. That's what I would say. But again, I don't want to be that guy that doubts people or discourages them. Trading is all about trial and error. And I've done the same thing. I showed it with my VIX options strategy, which is my longest running strategy. It's probably my most successful strategy. I do want to share it in a video course if I can get around to it. But I've showed the live results with my actual broker statements, and I'll do it again in the course that I put together. But I made, 30, 40, 50% every month with that strategy right out of the gates. I launched it in May 2011, and the first 5 months I was up 130%. And I thought I was a genius. Now, the one thing that I did right is I launched it in May. In August, I started stress testing. I was like, come on, this is crazy. This is not going to last. Clearly, I'm doing something that's taking on exceptional risk, and it happens to be paying off. I don't want to lose it all. So then I started looking for ways to manage the risk. And wouldn't you know it, 2011, European debt crisis comes along in August and September, and right in through November, it was a total disaster, right? But I had already stress tested my portfolio before that. I had realized my mistake, and I had actually started to overhedge at the time. So I didn't lose all my money, but I would have. If I kept doing what I did in May, June, July, I would have just blown up my account, right? I was totally exposed and I didn't really see it. Fortunately, like I said, I analyzed my performance when it was going spectacularly well. That's actually a really good thing to do. So I have personal experience with this, hitting a strategy that just, you can't believe how much money you're making. It just doesn't even make sense. You get out that calculator and you think, if I just do this for 3 years, I'm going to be a millionaire. This is insane. When you start getting that feeling, trust me, and I told myself the same thing. I'm not the greatest trader the world has ever seen multiplied by 100. Like, that's what you would be if you were making 30% a year or a month every month. You'd own the entire stock market in a few years. So clearly that's not going to happen. And stress testing during super performance runs is a great way to keep yourself in check and to keep that money. You want to keep those profits you made. So feel free to email me, give me some details on what you're doing. I never tell people any personalized investment advice, but I can look over what you're doing. There's not enough information there, but I'll give it a look. Maybe we'll brainstorm it together. For Iron Condors, what do you prefer? Shorting at 15 delta? Not other numbers. So what you're getting at is one of our rules of engagement for our Iron Condor strategy is we sell roughly 15 delta, 15 down to say 13, 12 on both sides. So you could call it a 70% probability of success trade. With Iron Condors, you can widen the wings even further, and you do really wide body Iron Condors. You could do 5 or 10 delta on either side, which would be very safe, very slow moving trade. Or you could narrow those wings up 30 delta, something like that. And those would be faster moving trades. And what I mean by that is your delta and your gammas are going to be higher. So if the market makes an adverse reaction, you're not going to be able to stop loss out in time. So I choose the 15 delta because it's very wide. And if the stock market crashes, 3-4% in a day or goes up 3 or 4% in a day, then I can get that reasonable stop loss. I want them to move slowly. So we do long dated 45 to 75 and wide wing, 15 delta on either side. But statistically, you could do 20, 30, 10, 5. It's going to all sort of be in the ballpark of that sort of, if the Iron Condor strategy, ours has made 18% a year since 2012, I would say plus or minus 5%, depending on strike selection. But it's not like me choosing 30 delta would break the strategy, or choosing 5 deltas would just radically change it. It wouldn't. It's just, I feel the risk reward is best at 15 because it's profitable, right? The premiums are still decent at that level, but it's slow enough moving that one of the worst things is when you get just way past your stop loss. Let's say, just for simplicity, because we also use a 50% stop, let's say you sell a contract for $1. When it hits $1.50, that's your stop loss. But if you're doing really narrow wing Iron Condors, there are times when the market's going to move on you. One day it's going to be close to the stop, but not quite. You go to bed, you think everything's fine. You wake up in the morning, markets crash. You can go from way past that $1.50 and it can go to $2, $2.50, and you can lose 4 or 5 weeks of profit in one day. That's what I try to avoid. So I like the lower delta options, just so that, if it rips past the $1.50, maybe I'm going to get out of there at 175 or something like that. You just don't want to give away too much. Personally, that's my style. Is stock replacement immune to the vol decay that affects daily reset leveraged ETFs? Essentially, the options market is an open, freely traded market, and I always say everything's kind of baked in. It's very efficient. There are not that many, newbies playing around in that space. It's fairly sophisticated, and everything's kind of factored in. So the decay factor of the VXX, for example, there's really no edge there. Everybody kind of knows at this point. It's been 14 years or whatever it's been. Everybody knows that these things decay. So everything like that is kind of baked in. The actual beta slippage of the products, it's kind of all baked into the options as well. That's what people are buying and selling. So I would say that I don't think it's some type of like a mechanical pricing, but yeah, I would say more or less it's all in there, because you can't really separate it out, right? You can say that it's the roll yield, it's the beta slippage, it's the gearing effect. Which one is how much of it? It's really difficult to parse that data. You can basically say there's 2 or 3 reasons why they're going down, and to say that one is 30% of it and one is 70%, we don't really know. It's just that's the speed. Everybody kind of knows the general trajectory, and then people are placing their bets. It's an open market. So sometimes you get on the right side of it. Sometimes people underestimate, they overestimate, but that's why we do high trade frequency, low allocation size, just churning trades. It's not a perfect world, but reminds me, I have a math degree, but I also did a double major. I did economics as well, and that was the always thing, in a perfect economy, perfect situation, perfect competition. Come on, this is the real world. My economics degree is useless. Thankfully, I did do the double with get a little bit of math in there as well. Mostly, I was just golfing. I just did a couple of degrees just to get the degree. But at that time, I was playing pro golf. So now I look back on it and think, oh, thankfully I did that. Can we profit from UVXY decay through option? I would assume the decay is priced in. I don't see any other comments. Maybe it skipped it. I think I just talked about that. Yeah. What you're doing when you're trading UVXY is trying to profit off that decay factor. How you do it, that's everything, right? There are many, many ways to short volatility. Not all of them are equal. There are some that are very good, some that are very poor risk-reward ratios. I'm not going to go into a rant, I promise, but all of you who do dabble in the naked calls, unfortunately, you are in the not such a good way to do it. And it's not because of the risk. The risk is a big problem, but it's mainly just a wildly inefficient trade. And you're just going to lose opportunity cost by tying up that much capital. There are so many better ways to short vol. Anyway, I promise I'm not going to rant. We do one almost every time. It's interesting. Initially with some echo, but after 5 to 10 seconds, it disappeared. I noticed that as well. When I click my little echo canceling button, there's about a 2-second delay. Maybe because I'm streaming to 4 different places live. My testing was not streaming at all, so it was a 2-second delay. I'll test that. Thank you. That's useful. Okay, when shorting butterflies, we do long butterflies, but why do you like to use puts instead of calls? Well, the only butterflies that we really trade in our portfolio are the broken wing butterflies on volatility ETPs. So, for example, just do the live trade that we have open right now. This is the one that we have on. This is what it looks like. Now, this month, we did a regular butterfly, but quite often we do a broken wing butterfly. But you can see the VXX or the UVXY, it will always start over here, and then we're going to hope that it's moving down because, of course, as we know, it typically does. There are times when it stays or spikes up, and you just lose a small amount of money. But generally, we are leading the trade. So it started here. Right now, it's here. And by next Friday, we're hoping it's obviously right there, pinned in the middle. Now, it's not going to happen exactly, but somewhere in this pretty wide range. And we're going to take a little bit of profit, and we just layer these over and over. So that's why we do put options for this. But if you were to do the same thing on, say, the S&P 500, for example, well, it has a positive skew. So yeah, you would probably lead the S&P up the other way. We do put options because obviously I'm not going to play the contrarian here. I am actually leading it lower. So it's always best to make the put options. Basically, the in-the-money option, you can see it's going to be this 16 strike. That's the one that you're kind of short on and the one that you're looking at. You don't want to open a trade that's already in the money from day one and moving the other way, right? Now, technically, you could trade the calls down here, but it just gets a little wonky with the way that things look. I mean, technically speaking, the options market is efficient enough that, where am I looking for? I guess you could do that, but there would be no reason. Yeah, it's because we do broken wing butterflies on VXX, UVXY. It's short vol. Okay, what is the craziest place you've been in the world? This is the first off-topic question. I like off-topic because, I don't have many friends. I don't get to speak to too many people. So when I'm on the live streams, sometimes I kind of feel like we're chatting, like just hanging out with the community. So I like off-topic. So craziest place I've ever been. Wow. All right, well, I don't know if it's the craziest, but it's just the first one that popped into my head. So in 1999, I was on the World Amateur Golf Team for Canada. They send 2 players from each country in the world, and we all meet in, a certain place. And that year, it was in Maracaibo, Venezuela. So I went down to Venezuela, and it just so happened that at the time that we were at the tournament, there was some type of student riots, like all over the country. There were barricades. We'd be driving to the golf course. There'd be barricades and fires and lighting buses on fire, like blocking the road and stuff. So what they did was, because there's 2 people from every country, pretty much every major country around the world. And they were very worried that at the time we were going to be kidnapped and ransomed or, whatever terrible things were happening in Venezuela at the time. And so they assigned a personal bodyguard for every single player. So I had my own personal bodyguard in body armor with a gun, basically following me around on the golf course as well. So I have this awesome picture. I should try to pull it up sometime. I lost my ball. I, drove down the right side, and it was right on the boundary of the golf course. And I was looking for my ball everywhere. And I walked up to it, and the guy motioned. He didn't speak English, but he motioned to me, and he was pointing at my ball with his gun. And my partner that I was playing with, 2-man teams, he snapped a photo. So it's me looking at this golf ball and this guy in body armor with his gun pointing at my ball. It's the coolest picture. But I would say that's probably the craziest. And they warned us, do not leave your bodyguard. Do not leave the armored car. Don't leave the hotel and all this stuff. But at the end of the tournament, this is insane. I didn't hear any bad news, so I'm going to assume it went pretty well. But everybody was talking about going out that night. And fortunately, I'm a little smarter than maybe the average person, and I declined that offer. So I did not leave the hotel. But from what I hear, a bunch of the people actually did go to one of the local clubs, which, what a terrible idea that would have been. I'm glad I was smart enough to avoid that. But yeah, I would say that was the strangest, craziest, but kind of cool as well. We were there for about 7 days, 8 days. I had wicked food poisoning. I mean, I basically ate white rice for 7 days. I think I lost 10 pounds and played pretty well. I was 3rd in that tournament, so pretty good for a world tournament. But I was just deathly sick. I was on IVs the whole week. It was crazy. Yeah, good times. Is that crazy enough for you? I'm sure there's more. I've been all over, some pretty weird places. To be a tax resident in UAE, Dubai, you need to spend 183 days in UAE. No, I don't want to get into trouble giving people bad advice because things do change and people do use them a little bit differently. But essentially, the rule is I'm going to add a second part to this, so don't get too excited here. But essentially, the only rule is you have to flash your passport every 6 months. So technically speaking, if you wanted to, every 5.5 months, you could fly in for a day and leave the next day and not come back for another 6 months. And you can go live in your home country. And an awful lot of people do that, right? Europeans, celebrities, right? I'm sure there is a lot of them. They don't advertise it to the world, but I think a lot of these people that I see sometimes just walking around, I think I've told the story. Like I was sitting at a coffee shop. I looked over, Conor McGregor sitting right there. I saw Ronaldo walking around the streets. I've seen the Beckhams walking around. I think, I don't know for sure, but I think some of them are probably legal residents of Dubai because it's zero tax. And then they kind of just come in for a couple of months. Like I'm going to Dubai on the 12th of December and I'm going to be staying there until probably February 1st. I would imagine that's the time when all the Europeans, the wealthy people, they're going to be there for a couple of months and maybe not again. Maybe they just go there for a couple of months and then they're gone back to their countries for the summer. So I don't want to give you bad advice there, but technically, no, you just do that. Now, the other thing, though, is in your home country, sometimes they have tax agencies that are strict. And if you spend more time in your country than you spend in Dubai, even though you're a legal tax resident of Dubai, they can still institute the rule that, well, where do you live, right? Like, I understand you've got a piece of paper that says you're a Dubai resident, but if you spend 10 months in London and 2 months in Dubai, I don't think anybody ever gets caught doing this, but technically speaking, you're a tax resident of London in that case. You're basically living there. I would never do this with Canada, right? Canada's quite strict with taxes. So if I lived in Dubai for 5 months and Canada for 7, even though I'm technically a resident, Canada could come after me and say, that's flipped. You're here for 7, you're ours. Your money's ours. So I do kind of follow the rules, and I would stay in Dubai, basically Dubai and Taiwan, and then I travel a lot, as you know. So between the 12 months of the year, I am trying to make sure that the majority of time I spend is Dubai. That might be 4 months because I was in Switzerland for a couple of months last year. I'm going to Italy for a couple of months next year. So as long as I'm, say, 4 months in Dubai, 2 months in Italy, 4 months in Taiwan, whatever it is, a month in Canada, a month somewhere else, then technically speaking, Dubai. But yeah, it's one of those places. The reason I was a Panama, I don't know if anybody's interested in this. How many people are here? 65. So I'll just keep going for a couple seconds. But the reason I was a Panama resident in the past is Panama is one of the only countries in the world, could be the only country in the world, where they literally, it's that rule is non-existent. So you actually can be a Panama resident and flash your passport once every year, and you can live 364 days in any country you want. And because it's a territorial tax system, it's not actually a zero tax system, then there's reasons for it. I don't know, but I ended up just swapping it out because I didn't like Panama. I didn't feel safe at all. You're wearing an expensive watch in the taxi. You're always thinking somebody's going to, get drove off somewhere and ransomed or something. It's a beautiful place, and I was right on the ocean. It was nice, but I didn't feel safe there. In Dubai, I mean, I'm not a super wealthy person or anything. I don't walk around with diamond watches, but no matter where you are in Dubai, you do anything you want. You can $1 million watch. You can go out at 3 a.m. Nothing will ever happen to you. It's the safest country in the world. I should say city, but. So yeah, don't want to mislead you. Consult your tax lawyer, but no, if you get your residency, you should be good to go. You just have to contend with your home country and just how much of a dick they're going to be to you if you happen to stay in that country longer than, and if they find out, well, I don't know. Don't do that if you're Canadian. Canadians, very strict. When shorting Iron Condors, why do you use stop loss at 50, not other numbers like 40 or 60? So kind of the same reasons that I was talking about before. Neither one of those is going to make or break the system either. Like I said, our Iron Condors do make roughly 18% a year. And I can actually click this course and just draw a picture for you in your mind so you can see it. Performance analysis. It's not going to make or break the strategy. So essentially, what happened? Welcome everybody. I should actually test that one day and see if there's an echo in there as well. But okay, so I do 50% stop loss, 50% stop gain, and that's based on the premium collected. So again, for simplicity, if you bring in $1 premium, the stop gain, 50 cents, When that premium hits 50 cents, we're going to take our profit. If it hits $1.50, we're going to stop loss out. The reason we do that is essentially Iron Condors are never balanced. I don't like to do 50-50. I like to do the 15 deltas. So you want to structure your trade so it is a 50-50 trade around that stop gain, stop loss. Now, you could do 40, but what happens if you do 40 is you're going to be stopping out pretty quickly, right? And so what ends up happening is you have to allow for a little bit of movement. Every Iron Condor, I mean, most of them, sometimes it just pins and it's perfect, but most of them, there's going to be some movement and you want to allow it to move around a little bit. So I wouldn't go much lower than 50. 40 might be still okay, but 25 is too much. You're just going to get a long string of stopped out trades because 25% happens a lot. 50 happens less. 80 happens even less. But then what happens if you go on the high side, now all of a sudden when you do get those losing trades, you're losing more money as well. And because we know the math equation that losses are more costly than gains are beneficial, it's not wise to take, some trades that make 80 and some trades that lose 80, you're actually losing ground. It'll bleed a little bit. So that's why I pulled up this track record. We launched in 2012. This line will look like the same shape. If you're doing 40% or 65 or whatever number you come up with, the shape will be the same. But I suspect if you did 40 or 30, you're stopping out too fast and it would be on the low side. If you're doing 80, you're really staying in trades an awful long time, then again, it's going to be similar shape performance-wise, but you're going to have more trades that go against you because negatively, a negative 80 and a positive 80, you're not back to break even, of course, right? We've done this equation before. You always want to manage those losses more. So 80 is too much, 25 or 30 is too little. Let's just Goldilocks it right there in the middle at 50. I'm Canadian. What are the tricks to pay less taxes on gains I made this year? Well, that's good that you made money. So anytime you can ask, how can I protect some of this cash? That's a good thing. I'm Canadian, but I haven't been a resident of Canada since about 2000, right? So it's been a good almost 25 years since I left Canada. Now, I've been back to visit dozens of times, probably 30, 40 times. And sometimes when I go back, I'll go back for 3 months. During COVID, I think I can say that word on YouTube these days, can't I? Enough time has passed. During COVID, I actually got stranded in Canada for an awful long time, much longer than I would ever want to. I love Canada. It's beautiful, but there are a lot of reasons why I do not want to be living there full time. So can't really help you out on that. I'm not a tax lawyer. All I can say is that if you do have a location independent income, then there are many places you can go in the world that you can set up your residency, you can set up your business accounts, you can maybe do some type of 3 or 4 flag system if you wanted, where you're a resident of one country, you have your business registered in a different country, you've got your bank accounts registered in a different country, and then you visit Canada. And as long as, like I said, the CRA will come after you if you're spending the majority of your time in Canada. But as long as if you did 3 different places, 4 months in each, you get a good solid 4 months in Canada. Now, again, this is not going to be very conducive to somebody who has kids, somebody who has a job to go to. But for location independent people, yeah, you can pick 3 countries and it's basically free. Like I've run the numbers a million times on my lifestyle, and just the insane amount of money I would owe the Canadian government in taxes, everything I do in my life is free. I mean, because I'm a tax-free resident of Dubai, everything is free. Like people sometimes say, well, oh, are you sure you're a minimalist? I can see your Airbnb. You've got, you're right on the ocean. You got these 10,000 a month places. Yeah, but it's free, right? I mean, I could save the money as well. I get it, but, lay off me a little bit. But the point is that when you save money on taxes, you can structure your life in a pretty efficient way and you can do a lot more. Obviously, don't abandon your wife and kids to do this plan, but yeah, you get the point. For me personally, it just works out very well. So I guess no book recommendations. No book recommendations. I did read a couple books way back in the day. I think I read Options and Volatility Pricing, and I read, I don't know, a couple of those, the major books, the Sheldon Nadenberg books and whatnot. 2 or 3 that pretty much everybody's read. I've read those as well, but other than that, audiobooks only for me. Can you include the Wheel of Fun part in the daily email? I can't, because I can't complicate things further than they already are. The VTS strategies are good. Like I said, we've got the starting 5 lineup. It's very difficult to replace these with anything better, even though I'm always trying every year to improve on everything. These are kind of just the staples right now. Now, it's not always like this. We've had others in the portfolio before. I've had about probably 10 or more in the last 10 years. But there's, 3 or 4 that are total staples, and then I'm just trying to improve on them. But the wheel strategy, I think that would start complicating the issue, because it's not technically in the portfolio. So if I start talking about this is sometimes just one of those realities of managing a community, right? You can't please everybody. There are some people who think what I'm already showing in the email is too complicated. There are other people who think, come on, can we get more trades? This is crazy. You only, this is so basic. I want every day trading. I got to try to find the balance. And basically what I default to is, where's my money? That's what I'm sharing. And then the VTS options is for those 2 or 3 other strategies that I have significant capital in. VIX options, volatility, step, wheel of fun, of course, some earnings trades. That's why VTS options was popular, because it was VTS was here. For anybody who wanted more action, they joined the VTS options as well. And I used to have it actually as a bundle, like you pay a little bit extra and it's bundled together and you get both of them. 2 separate emails, right? VTS emails, VTS options emails. It's not in existence anymore, but I will try to bring it back. Okay, I was hoping you would be in Taiwan in March and we could meet up. I will be in Taiwan in March, so definitely email me and we can meet up. I believe Chinese New Year is in, I think, February 7th. It's like the first week of February, something like the 4th to the 10th or something like that. So I'll be in Taiwan for Chinese New Year, and then I'll probably just stay, because I'm allowed to stay for 90 days. So I'll probably just stay, and I'll be in Taiwan for February, March, April, and then maybe go to Italy in April. So yeah, email me. I think I'll be there. We can meet up at Starbucks somewhere. I know several of them, so I'm the Starbucks guy, depending on where you are in the city. If you were to hold a synthetic SVXY position via puts, would you still use the same VXX put selection and just double the amount, or would you seek a different delta strike expiration? This is a judgment call. So because options are cash efficient, capital efficient, you could just take the exact same position and just double the contracts, and you'd have the margin, you'd have the capital to do that. So like I pointed out, when we were doing that head-to-head comparison, scroll over to that one. When we were doing this comparison, it was 11 contracts. You could just do 22 of these, right? You could just do that. And now all of a sudden you're doing the full, it actually works out to be a 1.2 delta instead of the SVIX is 1. But there is a little bit of theta decay, so it should work out more or less the same. But another thing that you can do, remember I said UVXY options are also liquid enough, so you could jump into there and you could maybe do a little bit less. It's totally up to you. Options and delta is a very basic math way to get the exposure you're looking for. More or less, you don't have to nail it exactly, but trying to do 1 times, yeah, double the contracts, increase the delta. Maybe if you wanted to reduce the delta on the UVXY and do 2 of those, or a 3 to 2, it's actually, these are simple numbers once you understand what's going on. So you can do whatever you want, absolutely. For simplicity, if you're in the VTS community, I don't mind telling you to just double the contract size. Or you didn't see that. I don't need the screen share. I don't know what you can see. It's late. It's now 3:30 in the morning for me, so I should wrap it up. Chinese New Year is February 10th, but close enough. The 10th. Thank you. I know I'm coming back on the 27th because the PGA Tour event is at my home course in Dubai, and I'm taking my wife. She's going to go get to see Rory. She loves Rory McIlroy. Don't know why. I don't really like him. After the whole live golf thing, I just think Rory's just an insufferable little brat, but that's just me. I used to like him before the live stuff, so I just, I don't like when people are in the way of other people's decisions, right? So if just to get everybody up to speed, the PGA Tour, several of the guys left because they got paid just ungodly amounts of money by the Saudis to go join that tour. And of course, people like Rory just spoke up and called them traitors and called them, all kinds of names. Why? Right? If a grown man wants to accept a $200 million offer, let the guy go and wish him luck. Like, you were friends the day before. Why don't you just say, hey, we won't see each other as much, but good luck. That's a lot of money. You do you. I'm going to stay over here. Why would we be influencing other men's decisions, right? They've got a family, they've got kids, maybe they're trying to build something else, and you're on this legacy path, and he's trying to take care of his family and his grandkids and all that stuff. Dustin Johnson's not young anymore, so he's approaching 40 years old. If he wants to take $200 million, I get it. I would too. So, Rory wanted to stay because he's young enough and he can win some trophies still. So good for you. You do you, he'll do him, and everybody's happy. So I didn't like that at all. But taking the wife to see Rory, that'll be pretty cool. There's actually a PGA or a DP World Tour event with all those pros at all three of the courses that I'm a member at. So I guess we could go to all three of them if we were there for December, January. Okay. He was in my employer's building a few times for interviews. Rory? Yeah. I mean, game-wise, guy's phenomenal. Brat level-wise, he's pretty high on that as well. So anyway, if you're a huge Rory fan, apologies. I'm always on the side of men to succeed and, get paid and just win, right? And how can you argue that a bag of money that big is not a massive win? I would never stand in the way of another man winning. I'm always cheering for them to get the maximum amount possible. It just doesn't make sense to me to be bitter about somebody else winning. It seems petty to me. But anyway, enough of the side tangents. Last question. I would expect a reverse split on UVXY in the coming weeks or months because of the low price. Could be, but you got to remember that the last time the reverse split, it took forever, and it went all the way down to, I think, $2.65. So you never know. Any price, the issuer can do splits anytime they want. My guess is they're going to wait a while, right? Because it's been bleeding down an awful lot. I bet you they're going to just see what happens. Maybe it goes down to 4 or 5, but maybe this is going to fizzle out in a couple of months and it's going to spike up again. And so they won't want to do it immediately. But yeah, I don't know. It doesn't matter. Remember, reverse splits don't do anything to any of this. Like, pricing wise, it's just less shares, different price. That's all it is. And options get adjusted as well. So this is a total non-issue. But again, it's random. Sometimes they reverse split at 9, sometimes at 3, sometimes at 6. Who knows? All right. Good enough. That was way too long. I'm going to go to bed. It's 3:30 in the morning. And yes, thank you very much for tuning in. I will review this stream and see if 1080p is any good. And I'll think up a good topic for next week. So see you all next week.